Crypto crackheads and cryptillians, it's Friday, March 5th, and welcome to the red dildo party. You're about to get Timified. So, since I'm going to cover overall Bitcoin, market, Ethereum, Cardano, and maybe something else here. But first, I'm going to start off with how to set up indicators here. So this is going to be a boring March, and really nothing's changed. The same darn things are playing out. So I want to try to show you things that over the years that I've developed to make looking at price less boring, because I've spent months and months and months from July 18 to November 18, with pure boring, and then we've had pure boring for quite a while in multiple time frames. So, where Bitcoin essentially becomes a stable coin at times. So this is going to be a sideways and down coin for probably the whole month. But anyway, so indicators that I use, I finally figured out which one, but there are a couple of options. So I don't like that one. So if you type in 5 exponential, this one should pop right up. Okay, 5 exponential. So this is the one with the stars, specifically the one I use. Now there's one that's almost identical. It's from Krown. It says 10-pack. Krown's 10-pack combo. The cool thing about his is that he's already got you all set up. One thing he doesn't have is the 10, and the 10 is very useful, especially on the daily and the weekly. So if you were to use these, and now in a bear market, you probably want to use these. This is like bear market moving averages, because you don't need, the 10 isn't as useful in a bear market. In a bull market it is. But the 10 really is kind of useful for getting signs on when things might go up for a glimmer of hope for a couple months. But if you wanted to change, move all of these down one and just get rid of the 377, but they all work the same. So Krown just used the same format as the other one that I mentioned that only has 50 likes or whatever. It's the same thing, but you have to move all of these down, as opposed to the one that if you type in 5 exponential, you can set them up yourself. Look, it's the same exact thing, right? Same thing. So that's how you find that one. I'll show you how to find other stuff I use. So this indicator down here is probably the most helpful indicator I've ever seen, outside of moving averages. And this is Krown's. So Krown Crypto he is by far, bar none, the absolute best crypto trader on the internet, on YouTube. And he goes into super technical things. And he's at a phase in his YouTube, YouTube life, creator life, where he just jumps right into technicals. He's not necessarily teaching. He makes things pretty fun. He curses a lot. And I stole his dildo from him. So dildo for candles, that's Krown. So that's trademark Krown. I stole that, just a heads up. I definitely give credit to him. I've learned almost everything I know from him, and a book, one of the trading book Bibles that are out there. I can reference that here a bit later. And also from Crypto Crew University. So he tries to sell his his trading learning program like 3 times every video. He typically only covers one concept over a 30-minute video, and kind of says the same thing multiple times. But the cool thing with Steve, who is the guy who does Crypto Crew University, crew with a C, spelled normally. Krown is with a K, Krown Crypto. And then, but anyway, Crypto Crew University is more macro decisions. So he works off of, even sometimes bi-monthly candles, monthly candles, weekly candles, and sometimes daily. But he typically sticks with macro stuff. And he makes things super simple down to only using like 1 moving average, right? Or 2. And so in Krown it's the exact opposite. He gets into the hyper granular, using like very expensive programs to see how much money investors are longing, how much money investors are shorting. However, to a certain point in trading, you're going to get to the point where you are seeing the same story just written with different adjectives, right? So all these indicators, whether you get fancy with with just, you can look at a bunch of indicators. There are tons, but they all essentially tell the same. They're telling the same story with different words. So it's like somebody rewriting a story and literally making the exact same thing. Almost like a movie tries to portray the book. You know, it's the same story, but it's done differently. Stuff like that. So he covers a lot of stuff, and it's extremely technical. So just heads up, those are two of the three main sources I've learned, and then the third one is the book called Trading for a Living. It is essentially the trader's Bible. So anyway, so that's the exponential. So Krown's RSI, Krown, it's this one right here. So with the control zones. So Krown, RSI plus EMA control zones will pop this up. And what these control zones are is it's an algorithm of likelihood. And so over time, you know, this white line at 80 or 79.8 or whatever it is, it's a good indicator of, you know, things are getting pretty hot. However, even if it gets hot and it creates bearish divergence like Bitcoin did here on the weekly candle, bearish divergence meaning, and there are a lot of ways you can have bearish divergence, but specific to RSI and price, so here we have RSI, this is the green line, the white line is the moving average of it. Which moving average is it? I don't know, it might be 20 days or 12 days, I don't know. But Krown has it set up to where it's best for his, you know, trading style. And if you want to be good at trading, a great way to do it is to copy somebody who's good at it. And Krown doesn't just talk the talk, he walks the walk. He's retired. Like, he has millions of dollars and probably perhaps over 1,000 Bitcoin, because I watched him. I literally watched him during the 2018 bear market turn 0.1 Bitcoin into 25, and that was his play account. So I just couldn't imagine how much his real account has. He might have thousands of Bitcoin, but anyway, he's the real shit. But he's a little harder to understand because he just jumps right into the hyper technicals. It probably took me about 4 to 6 months listening to his channel to start actually understanding what he's saying, but kind of like learning a new language. Actually, not kind of like, exactly like learning a new language. You know, if you walked over to Japan and you don't speak Japanese, you wouldn't understand it for the first year, right? So you start learning and learning and learning and hearing, and you know, things, you start seeing patterns and it starts making sense. So that's kind of what, but anyway, so I try to say things in a simpler way so you understand immediately. Plus, one of my 2 bachelor's degrees is teaching, so secondary pedagogy essentially. I have a knack for, I think I have a knack, one of the things I'm best at is I have a knack for explaining the aha moment, why something makes sense. And you know, Krown he just goes right through it, and you know, he shoots the shit a lot more than trying to find the aha moment, so it makes sense to people new to this. So my channel, what I'm trying to do is I'm trying to make sure that you stay safe out there, and so to do that I have to have aha moments so it makes sense immediately, right? So anyway, this RSI bearish divergence here is what bearish divergence means specific to RSI and price is that this made a lower high. So this is the weekly candle, see where I'm hovering the weekly? This made a lower high while price made a higher high. Oftentimes on the daily, it's a 3-strike rule in Bitcoin, and I don't think it played out this time. Nope, it just made a higher high here. So a lot of times in Bitcoin, let's see if I can find an example of 3 strikes. 1, 2, 3. So right here, 3-strike rule, bam, then it really started. So one peak, a second peak, a third peak, that is a 3-strike rule. This is on the weekly. Here, this is bearish divergence 2 leading up to the last bubble. This was a 3 plus a parabolic. So watch. This sets the highest high of RSI. RSI makes a lower high than this, but the price is higher. Price makes a higher high again, but RSI is still lower than this peak. So this peak is slightly higher now, but it doesn't matter. It's lower than the first one, and price is still higher. Selling here would have been a good, or getting stable here. Once this weekly candle turned red and kind of started coming down, getting out at about 67,000 or so, 6,800. that's why this, this red candle, is people seeing this divergence and like, yeah, that might be the top. Bitcoin's going to go down for a couple of years. And however, when it pinged off of the weekly 10 and came back up to here, people got right back in. So not only did the newbies, new blood, start getting in here, which really is what made it go exponential, but the price also had the force under it, like the fart or rocket power under it, because, professional traders and hedge funds and all that were in it early, they saw it ping off pretty aggressively off this 10 weekly EMA, and so everybody started buying at the same time, and it had a blow off top. So this actually blew off RSI highest like maybe it's ever been. Nope, no, it was higher here. Yeah, this was the most impressive run ever. I mean, it was just so fast and aggressive, it was stupid. But anyway, so those are indicators that I use mainly, and I also use stochastics. I just picked the one that says stochastic, I think. Yeah. All right. So on stochastics, a lot of new people might say, hey, if I just buy up here and sell once it starts crossing, I'm going to be in the money all the time. No, you won't. You use stochastics to help guide you with choices you're thinking about making given other clues. So stochastics should not be used as a principal, but rather a secondary or even tertiary, so third level tertiary, it's a fancy word, a tertiary means of making, of signaling. So I use it as a secondary and sometimes tertiary, but mostly secondary. So a lot of times I use stochastics for when I see a macro choice here, like I want to try to snag Bitcoin and go along around 39.5, which is what I'm planning on doing. But I'll probably move into Litecoin and Bitcoin Cash since they have not passed their all-time highs, and I think their next run is the latter part of the run is going to be more aggressive on a percentage basis than anything else. But anyway, so once it starts getting down here, then I'll move to like the 2 hour and 4 hour. And this is where the stochastics really come into play. So imagine price, I think it's going to take almost all of March. It comes down here, dips below it. And the 4 hour Stokes are crossing up, and they get past all the fake out points. So look at all these fake out points where the horizontal lines move up and down where my cursor is. Look at all the fake outs. So 4 hour fake outs, typically you're safe about here, and the reason why the fake out happens is because look at what else that white line is touching on a support basis. Look above it. Look at all those things going to the troughs going down. So the troughs going down are a support, but that support is also resistance. So a pretty, okay play on the 4 hour is once it hits your level down here at whatever time, late March or whatever, and you think, okay, I want to get in and greatly reduce the likelihood of me getting in, and then I have to wait a long time to have gains, or limit the likelihood of going down even further to the next level, like at 32,000. The play would be to wait till it safely gets past here. Now, are you going to lose out on opportunity because the price is all the way up here? Absolutely. However, it's safer than getting in right then, and then it comes crashing down when you're not looking, and then you're at a loss, right? So that's how I use Stokes. When to get in on a micro level, like a quick decision making, and sometimes the 2 hour. The lower you go, the more finicky it is, and the more false signals. 4 hour really is a perfect. It's just a beautiful blend. I love the 4 hour chart for making daily and weekly choices. 2 hour, if I'm being stupid and I want to try to catch bottoms and stuff, which don't try it. It's a good way to lose all your money if you're leverage trading. Don't do it. You wait for confirmation up or a safety net up, like momentum up. Catching bottoms is going to get you screwed. But anyway, when I'm stupid and try to catch bottoms, I use lower. So the lower you go, the more likelihood of you're making yourself lose money because it's false signals. that's how I use these main ones. Now, another really awesome indicator is, and I also learned this from Krown, is, gosh, what is it called? Accumulation distribution. It's not that one. Let me see if I can find it here. It's not this one. I might cover this in another video, but the accumulation distribution is an indicator, if I can ever find it, that covers surface area, like parabolas. And when the angle of it is going up on a monthly chart, that means you're macro bullish. You might have $8,000 dips down, but in general, the market's bullish. I wish I could find it, but I'll cover that on another video. And it creates surface area parabolas instead of like bars and graphs. But the main ones that I use are the moving averages set specifically to, and so the way to change your moving averages is to come over here. So see where my cursor is? The eyeball makes them disappear. See how all those lines disappeared? And they make them reappear. And the gear, so the gear, the settings, you can put in your inputs. And these are the inputs that I use. Now, how to use moving averages. So if you want to take a screenshot or pause it and set that up, that might be a good idea. Now, on the color side though, a lot of traders use red for 10. Yeah, like they. Sometimes people use white. I think Krown uses white for the 200. I like to use orange. But anyway, because a lot of my temporary lines are white, so I don't want to get confused. But to wait, so if you go like this, so see, look at the red line so over here where my cursor is, look at it. So if you go like this, it gets more and more opaque, right? So this is opacity. The thickness of the line is down here. So the three settings here is the color. You can make it change color. See how it's changing color up there? So red, and then you have opacity, and then you have thickness. And so that's what you got there. Now, the simple moving averages. So the MA means simple moving averages. I don't use all of them. However, I do like to use the 50 and I think the 200. I have 2, 3, and 5. Okay, I like to use the 50 and the 200. I use the 21 for the weekly and daily candles, and here's why. So here's how I like to, if I want to see sell signals, the 21 is beautiful on the daily, 4-hour, and weekly, really. And again, it usually is another way just to spot bearish divergence. So it's telling the same story in a different way. But it's like a double confirmation, right? So you know, when you're trying to look at something from afar, you know, and you squint your eyes, rub your eyes, and you ask somebody, hey, do you see that too? You know, that's what you're doing here. So this is another way to, do I see this too? The hologram effect. So when you move past the hologram picture, you're seeing it in different ways, the picture changes. So, and this is something that Steve on Krown Crypto Crew University does as well. He removes everything. MA2 should be yellow. Why didn't I have that yellow? Yeah, I like it to be yellow but thinner. So for my 20 MA versus my 21 EMA, I like to have it thinner but the same color, and you can remove them all. Now, so check this out. It's better on the weekly and the daily. So when these cross, so exponential moving average means it exponentially adds weight or authority to the more recent price. So and the simple moving average gives equal weight to the prior 21 candles of whatever time frame. If you're on the 4-hour time frame, it's 21 4-hour candles. It's I think it uses the closing price. Closing price is pretty standard. You can get fancy with it and change it to opening price or average price throughout the candle, or the mean, or the mean of the middle of the candle, the average of the candle itself, average of average. But I think most people use closes. But anyway, so what you can see here is because the exponential moving average exponentially adds weight to the, you know, the 3 or 4 most recent candles, but it's increasing. So the most recent candle gets by far the most, the next one a little less, the next one a little less, and by the time you get to 21, it's taking very small into consideration. But anyway, that means when price is going up, the EMA will be above the SMA every time, because it's exponentially considering, you know, the most recent price, and if stuff's going up, well, it's going to be higher. But this gives you a good tip off of, hey, on the weekly, you know, it just crossed over. So so when they cross, that means stuff's slowing down. And on the weekly, that means you're going down for a while. And let's see how this has played out. So crossed here. Did we go down for a while? Yep. Was there a fake out when people thought, oh, we're going to glory? Yep. But it crashed right through it. So that'd be a good signal to get the hell out again. So crossed over, it went down for a long time. Crossed over, it went down for a long time. Crossed over, went down for a long time. And you can see how this price got sucked into it. And why does it do that? So people can take your money. It does it on purpose. It is an important cross. The weekly 21 is super important. Like it's like, it might be the most played. The daily 21 might be the most played, actually. The weekly 10 could rival that. The weekly 10 and the daily 21 typically are kind of close. If price is going high really fast and there's a lot of price movement, then the daily 21 will be quite a bit above the weekly 21. But when price is choppy like this, they're often fairly close. Actually, let's just see. Maybe I don't know what I'm talking about and I'm making stuff up. So here, the weekly, so let's pick September 2019. Weekly 21 was at 9,100. I can't even remember what the hell date I just said. Let's pick, so yeah, 23rd of September, 9,000. $10,000. Was that the weekly 10 though? September. Weekly 10. No, 9,700. Yeah, so it was close. I think I accidentally used the 21 and 21. I meant to use the 10 of the weekly. So the 10 weekly and the daily 21, when price is kind of going sideways, and even though this is a lot of volatility, but on average, if you make a best fit line, it's pretty flat, which means there's a lot of money to be made, a lot of money to be lost here. But anyway, so they were within $300 of each other. But anyway, so the weekly 10 and the daily 21 are probably the most played in all of crypto, so you better look at them. And so going back to crosses here, the smaller the time frame, the faster you get the tip off. But there's a trade-off. It's not foolproof. The lower you go, the more fake outs you get, or the more false signaling you get. So while on the weekly, it's a no-brainer. It's played out 100% of the time, literally 100% of the time throughout the price of Bitcoin. You also lose out. I mean, look, if you sell here, that's at 10.7. That's after a 45% move, right? But it's safe, because it's played out 100% of the time. So if you go down to the daily, crossed over there, but price had already gone down, right? So maybe you could have done this and looked at it kind of crossing, and maybe you caught it about right here at 16,000. That'd be pretty good. And then shorten all the way down, to just maybe pick a key level. Bitcoin heavily drops to 40%. Actually, you'd have to measure from the top still. So I will short until 11.6. So that's $5,000 price action. You can make a lot of money like that. So the daily looks pretty safe too. It's a pretty good indicator. Now let's go down to the 4 hour, see how finicky and get how many false signals we get. So look, right here, if you sold, you're going up still. All right. And then it crashed. But here, false signal, look, it crossed and price kept going up. So, you know, on the 4 hour, it might be good to use if you do see, like on the daily, if you see bearish divergence on the daily, like up here, do we see any bearish divergence? We see bearish divergence maybe. So even though this isn't bearish divergence, this is kind of a tip off when RSI moves below the moving average, comes back up and pings off of it right there, like this is a good time to sell. Now, does the 4 hour, actually even the daily confirms this. So this is a no-brainer time to sell. No-brainer. Like everything's aligning to get the hell out. All right, let's see if it happens here. So crossed over, the EMA got stuck under, you sell, it came back up though. So, you know, this is just a lot of it's hard to make money when you're going sideways. Even though there's a lot of price action. So kind of a false signal there on the daily. But there was money to be made, because if you did it when it pinged, well, let's say when it pinged off, pinged off here, and there's a cross, if you sold, you could have gotten a, you know, if you said, I want to get out after a 15% move, well, no, you wouldn't have gotten your 15% move. It would have come straight back up and you would have gotten stopped out. So the 20 versus the 21 on the daily 4 hour. So look where my cursor is, 4, day, and weekly. You can utilize them in different ways. And remember the trade-off. Weekly, it's 100%, but you lose a lot of opportunity, but you're safe. Daily, it's kind of a middle ground. It's a pretty good blend of good signals and very few false signals, and you get your signal kind of quickly. 4 hour, there are tons of false signals, so the way you would want to use that is if you see bearish divergence on the weekly or the daily, you would want to use it on the 4 hour to try to get your extra confirmation, even though it's finicky. But if you know, like rubbing your eyes trying to see something far, do you see this too? You can ask the 4 hour RSI, do you see this too? So I would use the 4 hour RSI, for example, as a secondary confirmation source, not a primary. Primary would be daily and weekly stuff. So that's how I personally use these indicators. So let's look at the RSI here. So we have a big run on price up here, and then the RSI made another mountain, but it's much lower. So that's monster bearish divergence on the daily. So the daily really is a good play. I mean, on like every time. And here though, you would have, you know, if you would have sold here, you know, that's not the top, so that's a false signal because it just went parabolic. Although this, like all this here, is bearish divergence, and you know, if you weren't saying this is the market top, but I just, you know, I think it's a local top, and you see RSI the highest here, price goes higher here, and it taps out. You know, that's not a bad short. You know, you could get potentially, that's a 32% move. There's a lot of money to be made there. And you could tell yourself, hey, I want to get out of my short after a 15% drop or a 20% drop because I know what the average drops are. You can like tell yourself when to get out of your position so that you don't write it all the way down, see your money grow, and then it starts coming back, see your money shrink, and then it goes back to zero, right? So sometimes you just tell yourself, hey, I want to get out after this amount. That's how I play. And you know, one thing you want to avoid is doing something like this. Let me show you how to lose your money. So sometimes it's also valuable to look at what not to do. All right. Lower time frames. This is the 1 hour chart. Boom, ba boom, ba boom, ba boom. Big wick. Hey, oh, that's a big wick. There's a lot of pressure up. I'm gonna buy. Boo. Okay, all right. The 10 crossed above. That's bullish. Okay, all right. Time to buy. Here we go. Right. So trying to catch bottoms on lower time frames, and this is still good. It's probably gonna hit the white line. So trying to catch these bottoms is dumb. Like it literally will, and on lower time frames. So, and when you do that on lower time frames, trying to use RSI or moving average crossing as, you know, a signal to get in, you're gonna lose all your money. You will. I honestly, you know, the way that you would want to potentially use lower time frames is your entry point. When do I get in? Because on a macro or the daily, weekly is telling me something. You still really don't want to use them, because a better confirmation tool is a horizontal, right? Using a horizontal of when do I get in, like this white line here. I'm not going to be using these small time frames down here. I just know this is my indicator, right? That's it. And maybe go down to the 4 hour, like I said earlier, and use the Stokes on, hey, are we past the fake out point yet? And when do I get back in? After it crosses. So like my rule for myself, a trading rule is, if two things happen, I get in. First thing, price hits this. Second thing, 4 hour Stokes go above 42.5 or so. That's it. And as things are getting exciting and you see a lot of opportunity, don't let your gut start overriding your mind. Saying it comes down here, comes back up, you're like, ooh, I'm gonna get in. No, you probably just wait. You would want to wait until price comes back down to check something, and then if it bounces off something higher than this again, that might be a good time to go, but not as it just comes down and comes up. Like, you want to wait till it comes down, finds support somewhere, maybe higher, makes a higher low, maybe then get in, and then say, okay, what I was thinking earlier is not right. But you don't want to just wait for, oh, it didn't hit, okay, I'm getting back in. That's how you lose your money. So when your set rule looks to be wrong, you might pick the 4 hour time frame, nothing lower, because you get too many false signals. You might wait till it comes back down and finds support somewhere, because price doesn't just go up forever, right? Like, you know, price up. So if you thought, so let's say here, for example, let me give you an example. If you thought, I think price is going to make a 33% drop, because that's pretty average, right? So there's a lot of support here, and I'm going to set a rule for selling or buying back here. You see price come all the way down here, it didn't quite touch your line, but it got close, comes up. That's not a good time to do it, like I was saying earlier. Wait for it to find support. Comes back down, and what did the 4 hour Stokes do? It made a fake out, went down, past the fake out point, so going straight up from there, maybe about here. That would be the time to say, okay, the rule I set for myself isn't working out, price is not going to touch it. And then you have other indicators to try to say, hey, yeah, I can confirm that what my guess was is not going to play out, because you see this 200 moving average. The 200 on the 4 hour is very important. This is the exponential moving average on the 4 hour chart. If you see other faster moving averages go below it and then come back up, and then price comes down with the 4 hour Stoke, and then you get past the, that's how you use Stokes, you know, RSI, moving averages, to try to make good decisions here. And what else do I got for you? Yeah, I mean, maybe since this is going to be a boring month, I'll just go over different indicators, how to use them. But like I said, one thing to remember, like the core thing is, they all tell the same story in a different way. So using a million indicators isn't going to help you. You just set your top 5 and say, hey, I'm going to use these 3 as primary and these 3 to 5 as secondary and maybe 1 or 2 as tertiary, just to make sure, am I seeing it right? And that's kind of how you do it. So, but the big ones I use are horizontals from the weekly candle supports, horizontals, and moving averages and RSI. Those are those are my 3 primary. Stokes are my top secondary one, and that's all I got for you today. So prepare for a boring and bloody month of March until we hit this level roughly, and then we'll go from there. Talk at you later. And my crypto crackheads and cryptillions, you just got Timified.